Hi, I'm holding a single $100 bill, and by the end of this video you're going to know 7 completely different places you could put it, ranked from the safest option on Earth to the one that could wipe it out in a single afternoon. Somewhere on this list is the path that actually gets ordinary people to their first million. Most beginners pick the wrong one first. Not because they're careless, because nobody ever laid out the whole map for them. So that's what we're doing today. No fluff, no just believe in yourself. Just 7 real options, real numbers, and by the time we're done, you'll know exactly where your own $100 should go first. Let's set the rules. Every option gets a risk score from 1 to 10. As the risk climbs, so does the potential payoff. But here's the part almost nobody says out loud. Higher risk does not mean higher guaranteed reward. It means higher variance. Keep that word in your back pocket. It's going to matter a lot by the end of this video. Option 1. Risk level 1 out of 10. A high-yield savings account. Boring, I know. But this isn't really about the interest. It's about building what I call a shock absorber. Money that exists purely so a broken appliance or a car repair doesn't turn into a credit card spiral. Think of it less as an investment and more as insurance against needing a worse one. Every serious investor I've studied treats this step as non-negotiable, and yet it's the step most beginners skip because it feels unglamorous. Here's your subhook. You probably think saving money is the goal. It isn't, because left alone in a bank account, that same $100 quietly loses buying power every single year. The US dollar has lost the vast majority of its value over the last century alone. So savings isn't where your money grows. It's where your money survives. Growth comes next. Option 2, risk level 2 gold. If a $100 chunk of gold sat untouched since the year 2000, it would be worth several times more today. Not because the gold changed, but because the dollar measuring it got weaker. Gold is less an investment and more a translator between what things cost and what your money is actually worth. But here's the catch nobody mentions. Gold doesn't grow anything. It just refuses to shrink. So the real risk with gold isn't losing money, it's opportunity cost. While your gold is standing still, other assets might be compounding without you. Which brings us to the option most beginners underestimate completely. Option 3, risk level 3, index funds. Picture a bag of assorted candy where the factory already picked the best-selling flavors for you, so you get a taste of everything without handpicking a single piece. That's exactly what an index fund does with companies. Instead of betting on one business, your $100 gets spread across hundreds of the world's biggest companies at once. Here's the shocking part. Years ago, Warren Buffett, one of the richest investors alive, made a public decade-long bet that a plain index fund would beat a hand-picked portfolio of expensive hedge funds. The index fund won. Professionals, with all their tools and inside access, lost to something a total beginner could set up in 10 minutes. And the math on this one is the real jaw-dropper. Put just $100 a month into an index fund earning a historically normal 7% a year, and after 3 decades you're sitting on 6 figures from money that was never anything more than pocket change. That's not luck. That's compounding, quietly doing the heaviest lifting on this entire list. Now, if you think we're just getting riskier from here, you're only half right. Option 4, risk level 3, real estate investment trusts or REITs. Same low-risk neighborhood as the index fund, just a different building. Imagine thousands of strangers pooling small amounts of cash to buy a property none of them could afford alone, then splitting the rental income between everyone who chipped in. That's a REIT. You own a sliver of real estate without ever touching a mortgage, a tenant, or a leaking roof. By law, these have to pass almost all their profit back to investors, which is why, in some periods, REITs have actually out-earned the broader stock market. Option 5, risk level 4, buying and reselling undervalued items, collectibles, used equipment, niche gear you already understand. The risk here isn't the market, it's you. Your edge is only as good as your knowledge of what things are actually worth. Get that right, and this can outperform almost everything else on the list. Get it wrong, and you're just accumulating clutter with extra steps. Here's where most finance channels tell you to go buy individual stocks next. I'm not going to do that. Not yet. Because before you touch a single stock, you need to see how badly this can go, even for professionals. Option 6, risk level 6.5, individual stocks. This is where things get genuinely unpredictable. There's a famous experiment where a group of monkeys throwing darts at a list of stock tickers ended up outperforming several professional Wall Street fund managers over the same stretch. Let that sink in. Professionals with decades of training, sometimes losing to random chance. Which is exactly why individual stock picking without real research isn't investing. It's a guess wearing a suit. Option 7, risk level 9, cryptocurrency. Picture this. You put $100 into Bitcoin, forget about it, and one morning you check your phone and it's suddenly worth $320. You feel like a genius. You tell your friends. 3 months later you open the app again, half expecting to see $500, and it's sitting at $41. Same $100. Same coin. You didn't do anything wrong. The ground just moved underneath you. That's not an investment strategy, that's a coin flip wearing a hoodie. And then there's the option that isn't investing at all, even though millions of people treat it like one. The lottery. Picture standing at the counter, scratching off that last little box, heart actually racing over a coin you found in your pocket. That feeling is real. The odds behind it aren't. A majority of adults in lottery-playing countries buy at least one ticket a year, chasing odds so long that you are statistically thousands of times more likely to win an acting award than to win the jackpot. This isn't risk with a possible edge. It's risk with no edge whatsoever. The house has already won before you even scratch the card. So here's the ranking nobody gives you straight. For building real, boring, dependable wealth, the emergency fund and the index fund do almost all the work. Gold and REITs are supporting players. Stock picking, crypto, and reselling are where skill and research can occasionally tilt the odds in your favor, but only occasionally. And the lottery isn't on this list because it's an investment. It's on this list as a warning label. But here's the twist that actually matters more than any single option. The biggest risk on this entire list was never the assets. It was behavior. Panic selling during a dip. Chasing whatever's trending this month. Never actually starting because $100 felt too small to matter. The vehicle matters less than most people think. The habit is what compounds. So take your $100. Put the boring pieces in place first. Let time do what it's always done. And the next time someone tells you they don't have enough to start investing, send them this video because the truth is they already do. Now here's the problem this video doesn't solve. Knowing where to put your money is only half the equation. The other half is knowing when your own emotions are about to talk you out of the smartest move you've ever made. And that's exactly what we're breaking down next.